A lot of folks have seen their favorite growth stocks down 50, 60, 70%, and some are falling at very quick rates, where you're looking at drops of 10, 20, 30%, potentially even in a day. And that's giving people a lot of heartburn, and they're saying, man, how do I recover from these losses? What am I going to have to do? And, how do I stop the burn? This isn't a good feeling. How much further can it drop? And so you have a lot of questions like that. In this video, I'm going to talk about, core thoughts on recovering from one's losses and what one can do, as they look at the investment landscape and why it's happening in the first place. And if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And so this video is purely going to be a chat. I jotted down a couple of notes that I wanted to cover because a lot of folks are looking at loss and they say, Daniel, I see you're still doing these fundamental analysis on individual companies, but help me out with some sort of just catch up, given that you're starting to see some more tumult in the market. Now, when I say tumult, it is worthwhile to keep a little perspective here. A lot of these growth stocks, they're the ones that are down 50, 60, 70%. If you look at the major indices, they're not in bear market territory yet. They're a few percent off their high. If anything, they're still in a bull market territory. So it is worth understanding that there is this sort of vast difference between these innovative stocks that are unprofitable and down 50, 60, 70%. A lot of these SPACs down, significantly from their deal value. And you have the indices, which are near highs, within 10% of their highs. All-time highs after years of valuation expansion. And so this is a question that I ask, occasionally I get the privilege of teaching investing at college. And so one of the local colleges, and, I ask the students, okay, so what drives investment returns? What are the three things that drive your return with any investment in a stock? What are the three things? And really it comes down to three. And usually people have trouble getting it. And the reality is you need to understand these three because they're critical to driving your returns. It's sort of like a machine. You have to figure in each of these variables. And if you screw up one of them, you're going to be way off. So the first one is valuation. That's very obvious to people. Sometimes the multiple expands dramatically. Sometimes it contracts. The second is the fundamentals of the business. And the last is the distributions that the business will have to shareholders. That might be through, let's say, cash dividends, or it might be a spinoff where they say, hey, we're spinning off this whole company to the shareholder. But those are generally the three buckets that drive your return as a shareholder. And you should be able to pencil out, if you own any stock, what is going to drive your return from each of these three buckets. And if you don't have a clear answer, I think it's going to be this from this category, it's going to be the fundamentals, and I think they're going to compound at 10 to 20% annualized. If you can't pencil something out like that without understanding, okay, my valuation might be a headwind here of an equal amount, that's the question mark. That's the question that you need to be thinking about. And the reality is, and this is the part where a lot of people have trouble, and this is the reason why I think a lot of people lose a lot of money in the stock market over time, is that long-term, 5 to 10 years, 50 years, what's the biggest driver of your investment returns? And which of the three? And it's fundamentals. Fundamentals drive the vast majority of investment returns over time. Now, what about valuation? How much does valuation contribute, let's say, over a 5-decade period? And the answer is close to zero over a multi-decade period. It's very, very little relative to fundamentals. In some 50-year stretches, it's actually a negative contribution. In some 50-year stretches, it's a slight positive contribution. But by far, it's the fundamentals. Now, if you look at this, if you were to shrink your time frame from, let's say, 50 years to 1 year, what your time frame now is, what's the biggest driver of your stock performance? Fundamentals matter, don't get me wrong, but the biggest driver of your stock performance is probably going to be driven off that first component, which is valuation. And that's the part that gets a lot of investors in trouble because they don't realize, wait a second, most of what's going on is valuation related. And so that's the reason why it's so important that you get your valuation right in the first place. I strongly believe that valuation matters, and it's very possible that you overpay for things. So this gets to the next question. So why are growth stocks just absolutely getting hammered? Well, this gets down to the valuation. And this is the reason why I always do a back of the envelope valuation for the companies that I look at. And with a lot of these growth stocks, they were given full credit for what their future margins could be, saying, hey, I think this business that's currently at negative 30% margins will someday be at positive 30% margins. And in that scenario, I think 5 years from now being valued at 30, 40 times earnings is very reasonable. That is giving a lot of credit to a company that needs to prove themselves. That is a lot of sentiment driving the valuation, where people are saying, oh, I give full credit to this. And this is the reason why I like to think about that Warren Buffett quote where he talks about there's no such delineation between value and growth investing. It's all the same, because everyone's trying to find a value. You'd ideally find a growth company that trades at a good value. That's the whole point. That's the reason why Warren Buffett called that out. He doesn't buy into these false dichotomies of like, oh, growth investing or value investing. The point is, you're trying to look for things where there's a fundamental backstop, and even if you're wrong, it can still work out. That's the point of what this quote unquote value investing is. Warren Buffett loves to find growth companies. And so the reason why a lot of these innovative stocks, are down so significantly is because they had full credit assigned to a very rosy future, and there's no room for them to miss. And also there's this change in sentiment that's going on right now, where effectively investors are saying, you know what? I want a discount if these companies are unprofitable right now. And that in my opinion is largely warranted. If you have a company that doesn't have significant profits right now, if it's significantly unprofitable, maybe it should warrant a huge discount to what it could potentially do 5 years from now, 10 years from now. But if you give full credit to what they theoretically could do 5, 10 years from now, then you're giving yourself no margin of safety. And that's the core crux of it. And that's, I think, what's the great reset that's going on right now, where these growth companies are now going to prices that might start discounting their future potential. Where you say, yeah, I think this company can do 30% margins. Previously, I assumed my return would be, let's say 10 to 20% annualized based on this. But now I'm going to get even better potentially, because it's now getting discounted. It's not assuming that you're going to be able to actually hit those margins. If you hit those margins, that'll be fantastic. But you know what? We're going to discount it because you're not there yet. You're unprofitable. And that's where you see these price to sales multiples go and swing in dramatic directions. Generally, when you're paying for things with a single digit multiple price to sales and it has really fat margins, that smells like an interesting territory. When you're paying, 20 times sales, that's, you're starting to look at a risky value proposition, especially when you realize that a lot of the mega cap stocks that are profitable and growing at a good clip, growth and profitability trade at, single digit price to sales multiples. So this is the end state for a lot of these growth businesses. And you sort of say to yourself, well, wait a second, this is where this will be valued someday. If this is a major headwind going from, let's say 20 times sales to 5 times sales, how is this company going to do as an investment, recognizing that that's a major headwind? I mean, go check yourself. Check out some of the major mega cap stocks, and you'll see, wow, a lot of these companies trade at, single digit price to sale multiples. And this is the end state for a lot of growth businesses, a lot of successful growth businesses that have proven their margins. So if that's the case, then, how much of a headwind am I going to be dealing with some of these growth companies? And many of them still, even falling 50%, they still trade at, let's say, a teens, valuation on a price to sales basis. So still significant downside if sentiment, that valuation component, continues to compress. So how much more pain? In all honesty, when you have a period like this, no one knows the exact answer, but I would expect, to have a really volatile ride. You look at the history from, let's say the great financial crisis or the dot-com bubble. That's a really good one, because you see periods where it's just completely brutal downdrafts, but then you have these rallying, bear market rallies where things will rally 20, 30% and people will think the worst is over. And so that's the reason why it's so fundamental for you to say, okay, I'm not going to get caught up with the day-to-day, and I'm going to focus on what's the actual fundamental value for this business, recognizing that, this is theoretical margins for a lot of these growth businesses, or, what's this growth rate? And so what can you do? What can you try to do to recover your portfolio at this point? Because that's the question I think a lot of folks are asking. And so I think it comes down to a few things. One is, if you find yourself in the hole, first of all, you got to stop digging. And so, if something's not working out for you, either because the valuation is contracting or they're underperforming or their fundamentals aren't delivering, you need to understand which is which. Is this declining because it was just expensive and now it's less expensive? Or is this declining because their results stink? Arguably, oftentimes you see the results stink and the stocks are really getting hammered. If the results are stinking, then you probably shouldn't keep on digging. But if it's because the valuation's coming down, then I think it's worthwhile for you to say, well, wait a second, what's the value of this business? What's a reasonable value? And you should be able to pencil it out. Say, oh, okay, I think conservatively you have this growth rate, and 5 to 10 years from now you have this margin. 5 to 10 years from now you have this PE multiple, this multiple on their profit. And then you say, hey, where's that price relative to where it is today? And if the price is close to where it is today, then you still potentially have a lot of downside. You want to ideally, once again, what Buffett was saying, there's this false dichotomy between value and growth. It's all the same. You want to have a discount between this intrinsic value of what this company's worth, even if it's unprofitable. So that's the first step in terms of thinking about one's portfolio. And keep in mind, I'm not against having a bit of unprofitable growth in my portfolio, as long as it's, in proper moderation. I'm not going to go all in on an unprofitable company. I think that's an imprudent thing to do. I'd want to make sure, okay, is this company sustainable? And that's sort of the next level thing for you to consider is, okay, so this company is currently unprofitable, but how sustainable is it? What's their burn rate? How much cash do they have on hand? Can they survive? What if there's a recession? You need to start asking questions like that, because that'll impact your growth rate. If you have a much lower growth rate, then you're going to have a lower outcome, obviously. And so thinking about this from okay, these are areas where potentially my portfolio will recover, or it's potential areas of more pain when you start thinking and penciling these things out. Okay, and oftentimes you see in my videos, okay, here's a quick back of the envelope of what I'm penciling out for the upside. And if I'm not able to easily pencil out, let's say 50 to 100% on a conservative scenario for an unprofitable company, I'm just not interested. And so I'd want to, once again, so a couple of things that I'm considering. One is it needs to be a good discount for an unprofitable growth company. I obviously want unrivaled companies, so I have a strong belief that they'll continue growing no matter what the economic environment is, that they'll be winning from competition. I want to make sure that it's sustainable, that they have the cash on hand to survive and thrive. If they don't, or there's any question, I'm not adding to it. Everyone has their own share of losers. I certainly had a loser or two, this past year. And so I'm looking at it and I'm like, okay, if management's not delivering and, it's not performing, yeah, I'm not going to add to it. Absolutely. So that's you try to be as rational as you can with the things that don't perform. Don't keep digging if it's not working. And so as you start thinking about how can you recover, you consider, okay, is this trading at a reasonable value relative to what I think the intrinsic value is? So if you're saying, wow, this intrinsic value is way above than the price, then you shouldn't care what's going on in the stock market. You have some bets where you're like, hey, this thing has 100, 200, 300, 500% upside. And if that's the case, you can just close your eyes. You can check out. You say, I don't need to check on this stock. I'll check on it next quarter. No need. Only if you're really crazy about looking at stocks, do you need to look at them every day. The reality is just check on their fundamentals on a quarterly basis if you need to. You can tune in, check out Unrivaled Investing where I'll give you updates and stuff like that. So then what's another way to potentially, recover your portfolio, and what am I considering doing? Once again, this false dichotomy of value versus growth, which is that, wait a second, what's everyone want? Everyone wants cash flows at the end of the day. That's the holy grail that everyone's chasing after. You want fast growing free cash flow over time. That's the ideal. Okay, so you make trade-offs. You start thinking, okay, what's the actual free cash flow here? And you start buying companies that trade at reasonable multiples to free cash flow. I've called out a few on this channel. Or if it's an unprofitable growth company, then I say, okay, then it's going to be a smaller percentage of my portfolio. But when there's a solid valuation backstop where I'm saying, oh man, this company is going to generate X amount of X billion dollars in free cash flow, and it trades at 10 times X, that gets me interested. Because I know, okay, if this stock falls in half, yeah, it'll go from 10 times free cash flow to 5 times free cash flow. So that, I'd argue those are the different components for which you to consider recovering your own investment portfolio in this environment, which is one, reassess what you have. Don't keep digging. Don't double down on a losing proposition if, let's say, it's the fundamentals that are worsening. If the fundamentals are worsening, you should check it. You should figure it out. you should have a clear understanding of what you think the intrinsic value is versus the current price. And you should be able to pencil out, okay, here's a reasonable range of upside that I'm playing for. If you're playing for, I'd argue, 50% or less upside over the next 5 years, it's probably the wrong bet. You should be like, that's my own personal take, especially because in periods of severe dislocation, which we might have with the Federal Reserve starting to raise rates, you can have stocks that have upside of 300, 400, 1,000% upside over 5 years. You can have that. That's what happens during severe disruption. So you need to consider that, okay, what am I playing for? And it should be obvious. It should knock you over the head. But if you're like, oh, this company is negative 30% margins, I'm assuming 30% positive margins, I'm assuming 30 times sales or 30 times earnings 5 years from now, and I'm assuming 30% growth over the next 5 years, and that pencils out about 50% upside, that's not a good risk reward. You're not playing for a lot of upside in that scenario, and you're making a heck of a lot of assumptions. So, once again, understand what the intrinsic value is. Don't double down on losing bets. Then I'd say understand that there are good bets out there that are cash flow generating, free cash flow generating, where you're saying, hey, can I try to buy at a reasonable multiple? And this is where portfolio management comes in, because you need to think about, okay, do I want to put the biggest bets on these unprofitable companies that require a lot of assumptions? Or do I want to place bigger bets on the types of setups where, oh, they're cash flowing a lot, there's less risk to the business model? And that's different types of things to think about. Oh, this company trades below liquidation value and it owns some really fast growing assets that have a lot of cash flow. Yeah, that setup is probably going to do better over time. I'd consider making that type of thing a larger allocation than, let's say, an unprofitable growth stock that I'm excited about. There's room in your portfolio for both, but recognize one takes a lot more assumptions, and hence there's a lot more risk that you're wrong, that they don't execute. So anywho, I'm trying to think about, what can be helpful in terms of helping investors to understand, okay, how do you recover your losses? And I was thinking about making maybe a regular video once every week or two, sort of having a chat like this for the folks that are interested with the topic of interest. So if this has been helpful for you, please make a point of hitting that thumbs up, hit subscribe button. Thanks so much.